When do we see a market that finally crystallizes around a consensus for GDP growth and most particularly rates?
The one thing that's also interesting, in addition to what you've just said, is that we've had a big surprise. All the surprise indices have also moved to the upside. People were too pessimistic in Q4. Now they're getting more optimistic for Q1. And we do think that we need to kind of get to see and observe more data in the early part of 2018. But we do think the momentum is carrying forward, and we'll get a boost from all this fiscal stimulus for sure.
In the interview with Austin Goolsbee by Mike McKee, I don't know if you caught it, but he continued to emphasize that increasing deficits during an economic boom is not a great idea. So it's not surprising that we're seeing this environment where the Fed is tightening and is at the same time we're seeing that it's going in hand with less deficit funding, so less debt issuance. That should be the norm. Right now we're going in the opposite direction with fiscal policy. What impact will this unique environment have?
That's a great question. I do think and I did see the interview with Austin. I think he brings up a lot of good points. When you're doing deficits when you're coming out of a recession, that makes a lot of sense. But when you're kind of adding fuel to the fire at a full employment economy like we are right now, it does run the risk of inflation, and it runs the risk of bond markets having to discount that on the curve. But if you look at the way the bond market's been behaving, bond market's been very dismissive of this actually having any lasting effect. And it's one of the reasons why bond market investors are kind of putting on flatteners with this kind of view that they're dismissive of any of this stimulus actually working its way through, or deficits actually matter.
Yeah, I mean, Cameron Kreis, one of our strategists at MLive, was talking about this morning. Maybe they're just really committed to their short positions. Is that possible?
It's possible that people are just so used to this kind of standard approach that Fed hikes, put on a curve flattener, and kind of retire. We think that's a very bad decision to make early on. The curve is flattened so much already. We're faced with all this fiscal paper coming, and we don't know how this is going to work out. We're, again, dealing with full employment. Fed's unwinding the balance sheet in addition to hiking, so that also should introduce some sort of a drag on long-term rates, but yet no one really cares about it. I think investors have been confounded, will become confounded when rates start to rise across the curve, not just short-term rates. And one of the reasons why is that people have been so used to the low rate environment for so many years, number one. And number two, we've had just kind of the structural factors of like demographics that have kept rates lower for longer. But this might be the year, which we think it is, where cyclical factors like inflation and more debt will actually start to weigh on all yields across the curve.